Mixed reaction.
Okay, well, Ed Yardeni is now joining us, President at Yardeni Research. Ed, good morning. Good to have you with us here. Thank you very much for your time. You know, the weakness in the US data is not showing up. I mean, the core PCE perhaps is one of the many which kind of showed some amount of weakness, softness, but otherwise it's been pretty strong and steady. What does it mean, Ed? I mean, once again, markets have been pricing in hikes in July by the Fed. This week, we've got some data points lined up out of the U.S. So we get a July hike and then what? More? But the market seems completely unconcerned. Ed, you'll have to unmute yourself.
Ms. Yardeni, you'll have to unmute yourself, sir. We would like to hear what you have to say. All right. Ms. Yardeni, are we audible? Nope. All right.
Okay.
I think we'll just fix that.
Ed, can you hear us? Okay, I think we'll just... okay, I think he is with us. Okay, I think we'll just have him back in just a bit from now. Some technical issues coming up. Let's just quickly take a look at what age... Yeah, Ed, we can hear you. Go on. Sorry, you were on mute, okay, but now we can hear you. Go on.
Okay, and you can see me as well, right?
See you and hear you.
Good. All right. I don't know what happened to the microphone, but anyways,
no problem.
Good to be back. Good to be back with you. Look, I think investors have come around to appreciate that the economy is remarkably resilient, and it's withstood a 500 basis point increase in the federal funds rate. So I think investors are getting kind of confident that even if the Fed does another 50 basis points, that's not going to be a problem for the economy. Meanwhile, we are seeing quite a bit of improvement in the headline inflation. As you point out, the core inflation is still quite sticky, but quite a bit of that is rent. We know that rent inflation is going to continue to come down. Meanwhile, there's liquidity in the economy, enough to keep the stock market moving higher. I hope it doesn't go into a melt-up situation. I hope that we kind of rest this summer and then move higher later in the year. But I don't run the market's playbook. The market has a mind of its own, clearly.
Ed, morning. This is Reema here. How does India stand in the emerging market basket? Investors bet on China at the beginning of the year on hopes of reopening, and money moved away from India into China. But that turned in the middle of, sometime in February and March, once investors realized that the promise of China growth reopening isn't materializing to the expectation, as according to the expectations, and money once again moved back into India, and FIs have been lapping up India. How does India stand in the mind of foreign investors, and how does it compare with the emerging markets?
Well, I think you're right. A lot of investors clearly are looking at China and India as alternative ways to invest in emerging markets in terms of having very large economies, large populations, and very industrious people. And you're absolutely correct that once China eliminated its lockdowns, there was widespread expectation that China would really show a very strong economic growth. But I think what has been revealed is that the underlying weakness in the Chinese economy is very much related to the property market. They've had a property bubble that's burst, and I don't think there's much they can do to turn that around. And that's been an important source of economic growth over in China. Do you know that imports in China have been flat for like over a year now? That's a very telling indicator, I think, that domestic consumers just aren't responding to the end of the pandemics with the kind of enthusiastic buying binge that we saw in other parts of the world, particularly in the United States. So compared to all that, India looks quite good, and especially in a geopolitical context where there's increasing concerns about doing business in China, manufacturing in China, because of the geopolitical concerns. And as we just saw with Prime Minister Modi visiting the United States, The United States is reaching out to India and would like to partner more with India and less with China.
All right. Hi, Ms. Yardeni. Good morning. Nigel on this side. A couple of questions. You said that we could possibly get a couple of more rate hikes. What are you factoring in? How many more hikes in this year? And by when do we get the first signs of a cut from the Fed? Because the equity markets, they want that. Some said at the end of 2023, but it's more likely now in 2024, going by the commentary that we're getting out from the Fed.
Look, I think we have to be flexible and open-minded here on what the Fed policy is going to do. And we do have to listen to the Fed. There's an old adage, don't fight the Fed. And if Fed officials are telling us that they believe that inflation is still too high relative to their 2% inflation target, and that the Fed funds rate isn't restrictive enough to bring inflation down to 2%, and that they will believe that they need to do another 50 basis points between now and year-end, or even the next two meetings, then we have to take that at face value as the most likely scenario. In my opinion, the economy's resilience doesn't suggest that inflation can come down on its own. I think a lot of the inflation was related to the shock and the aftershocks of the pandemic. As the pandemic is abating, I think we've seen inflation come down dramatically in goods markets, and it's in services that we are seeing persistence. But I think that will change as well. But I have to factor in that they're going to do another 50 basis points because they're quite adamant about it.
Maybe, I mean, actually, on the flip side, once they start to cut, maybe the market will not like that, right? Because the cut will finally come when the economy starts to weaken. I mean, they're just happy. I mean, 500 basis points and the market is doing just absolutely fine. Right?
Well, there's a lot of moving parts here. We know that there's a lot of enthusiasm about artificial intelligence, and that's been a big source of strength for the technology sector. We also have a tremendous amount of spending going on by the government in infrastructure spending and on incentives for onshoring to bring manufacturing back to the United States. So industrials have done extremely well. And now we're finding out that the financials are doing well because after they got hit quite hard back in March, I think there's a growing sense that we're not going to have an economy-wide banking crisis. And as you know, last week, the Fed reported its latest stress test of the banks, and the banks passed the stress test. However, it was the 23 largest banks. It wasn't the 4,000 small banks that still have a lot of exposure to the commercial real estate market.
But at least the 23 large big banks passed the stress in light of what we had to face in February and March with the collapse of 3 regional banks. Ed, thank you very much for joining in. Need to get into a very short break. There are lots of individual stocks.